Hi everyone. Good evening. Can anybody hear me? I want to be sure you can hear me, or can anybody see me? Am I visible? Please, can I get a yes? Can everyone see me?
I am Mobolaji. Yes, I can see you.
Okay, so I guess I can be seen. Hi, good evening, everyone, and welcome to another edition of this webinar. We had our first edition last week, and this is the second edition that we'll be having this week. And this webinar is powered by Tyms. And Tyms is a company that has a software, an automated software. It is a new innovation seeking to help CFOs, accountants, and business owners in managing their finances, streamlining their transactions, helping them to generate books of financial reports, helping them with their KPI metrics, just to know the overall financial health of their company. So today we would be having the second edition. Like I said, we had the first edition last week, and today we'll be having the second edition. And today is tagged a step towards profitability. That is mastering revenue recognition. And today we would be looking into series of things regarding this. And for now, we would be having just three of our speakers who would be doing justice to this topic. Our guest speaker for today is Zulfah Isimekhai, who is the accounting lead consultant at Zaslam Consult. She'll be taking us on the importance of revenue recognition, and also the possible challenges that businesses might face in recognizing this. And this will be done from around 6:05 to 6:35 thereabouts. And then thereafter, our accountant at Tyms, Mobolaji Maborukoje, would be coming on board to take the next part of the webinar today, which is revenue recognition methods available for businesses. And thereafter, our product manager, Arannilewa, would be doing a short demo on Tyms, and then thereafter we can have our question and answer. But mind you, during the course of each session of the webinar, you can drop your questions in the chats, and then it will be attended to by the speaker for that session. So please kindly mute your mics and turn off your cameras to be able to so that everybody can have a good learning program. Thank you very much. So without further ado, I would like to welcome Zulfah, who will be our guest speaker for today. Hi, Zulfah.
Hi, Mobolaji. Good evening. Good evening, everyone. Thank you for having me here.
Good evening. Nice to have you here. Can we have you, Zulfah?
Okay. We'll just jump right into it because of time. We'll need to keep to time. I don't know. Can you see my screen now?
Yes, we can.
Okay. Awesome then. So please, let's just jump right into it. A step towards profitability, mastering revenue recognition. I think it's a very, very interesting and important topic for all business owners, CFOs, finance managers, accountants, aspiring finance people. It's a very major concept for any business, because at the end of the day, the reason for being in business is profitability. And one of the things we need to do to ensure profitability is recorded is to ensure we recognize revenue the way it is to be recognized. So let me just give us a brief background. We need to know what revenue is, and we have we have different accounting standards that actually treat revenue and say one or two things about how revenue should be accounted for. But we'll go with IAS 18, which says revenue is the gross inflow of economic benefits such as cash and other receivables arising from the ordinary operating activities of an entity. So this can be in form of a sale of a good or rendering of services. And IAS 18 also says that revenue should be measured at the fair value of the consideration received or the receivables. So we'll talk about what revenue recognition is. There's also an accounting standard that says revenue recognition directs all entities to recognize revenue when the promised goods or services are transferred to the customer, right? So that is when we actually recognize revenue. And there are steps to implement for proper revenue recognition. We need to identify the contracts with the customer. There must be a contract in place. There must be a conversation that a good is going to be exchanged or a service is going to be rendered before you can even start considering revenue recognition. You identify the obligations, you determine the transaction price. There can be no sale, there can be no rendering of service without an agreement on the price of what it is going to cost. And then you allocate the price to the performance obligations before you now go ahead to recognize your revenue. Now, the major thing of this conversation is for us to know the importance of revenue recognition. Revenue recognition, the importance cannot be overemphasized. It is very important for businesses, for accountants, for CFOs to recognize revenue and recognize revenue properly, because the very first thing is that it is the foundation of your financial health. The reason for being in business is to make profit at the end of the day. And you cannot do that if you are not accountable. To a very large extent, I would say the finance department is the backbone of an organization to a very large extent, because if you don't have your figures right, then there's nothing you are doing in business. You may as well just be running a charity organization. So revenue recognition is the heartbeat of a company's financial health, right? It serves as the bedrock upon which financial decisions are made. In every company, you have various stakeholders, from your employees are your stakeholders, to your investors, to the shareholders. These are all stakeholders, and we need to be able to set that foundation, that bedrock in place to gain the trust of all our stakeholders to ensure we remain in business. Now, another very important importance of revenue recognition is informed decision making. You cannot make decisions on what you want to do in your business because you are going to incur financial expenses. So if your revenues are not recognized properly, your financial statements are inaccurate because you have recognized revenue incorrectly, it means you won't be able to make financial decisions. So it is important to recognize revenue properly, accurately, in line with the financial standards to ensure you're able to make informed decisions in your business. The investors are going to use it to make decisions. The shareholders are going to use it to make decisions. You need it at the end of the day. You need to go through your financial statements, check your cash flow, and see if you're actually making money in your business or not. And the only way you can do that is to first recognize your revenue properly. And then another importance is that we need to comply with regulatory bodies. If you don't recognize your revenue as it should be, as the accounting principles have laid it out, then your financial statements are going to be misleading at the end of the day. So it's very important that as business owners, as financial people, as accountants, we should first primarily understand the accounting principles that govern revenue recognition so that we can comply with them and get our financial statements accurately. Businesses encounter challenges because they are not able to recognize their revenue properly. They will recognize a revenue when it shouldn't be recognized. It shouldn't even be called revenue in the first place, and then it is captured. That's already a very misleading information, and they are going to encounter issues in the long run. Now, for businesses that don't implement revenue recognition properly, these are some of the challenges they may face. Misleading financial statements. Financial statements is the report card of every business. It shows how you have done well. It shows your financial position. It shows your cash flow, how well you have done for a period of time. So if you've recognized revenue wrongly, then you're going to have a very misleading financial statement. It will lead to distorted financial statements. You provide an inaccurate financial position of the company. And let's be reminded that I initially said that the stakeholders use it to make informed decisions. So if a stakeholder, let's say the investors, you're a business that has investors on board, they are going through your financial statements, hoping that the finance department has done what it should do, and then the financial statement is inaccurate. That's already a very misleading thing for investors, for your stakeholders generally. They are going to lose their trust. They are going to bring about reputational damage to your business. That's why it's very important revenue is recognized properly. And then poor decision making. Inaccurate revenue recognition can result in flawed data. That's guaranteed. Once you recognize revenue wrongly, your data is going to be incorrect. It's going to be flawed because it's what you give, you get. It's going to be flawed, leading to poor decision making. Executives may make strategic choices based on faulty financial information, impacting the overall direction of the business. Legal and regulatory consequences. Another challenge is that incorrect revenue recognition may lead to legal and regulatory consequences. Non-compliance with accounting standards or regulatory requirements can result in fines, penalties, or legal action. Non-disclosure, so many legal implications to not recognizing revenue accurately. Eroded stakeholder trust. I'd already mentioned this. Stakeholders, including your investors, your customers. Your customers are what keeps you in business. Without your people, which are your employees, and without your customers, you are doing nothing in business. So these stakeholders rely on accurate financial information to make informed decisions. Your customers want to know if they should keep their trust with you, if they should continue to do business with you, and then you give a misleading information, it can cause the trust they have in your business to be eroded. And then you have contractual issues because before you even want to recognize revenue, a contract must be in place. So it's oftentimes to contractual agreements, and errors in recognizing revenue can lead to disputes with customers, suppliers, your partners, and so on. And then you start to have cash flow challenges, not knowing where the problem is coming from because you have inaccurately reported that everything is okay. So incorrect revenue recognition can impact cash flow management. If it is recognized too early, it may lead to overestimation of cash flow, creating challenges in meeting financial obligations. When you have estimated your cash flow, the stakeholders take that state analysis and use it to make informed decisions, and then they can implement after making those decisions. So these are some of the challenges and why it is very important for revenue recognition to be carried out properly. So I think those are like the major things. I just said to mitigate these challenges, business must establish robust internal controls, stay informed about accounting standards, very important, and invest in training for finance team to ensure accurate and compliant revenue recognition practices. So thank you so much. I hope I've been able to cover the topic and broken it down as much as I could. I didn't want to use most of our big terminologies because the idea of communication is to be able to tell the next person something and the person understands it perfectly. So thank you so much.
Thank you very much, Zulfah. That was quite, I gained a lot. And from what you said, one of the things that really stood out for me was when you said that finance, sorry for the glitch, that finance is the backbone of every company. And that if you can't recognize your numbers, you might as well be running a charity, which is like simple and direct. And you also, or those that just joined us, she also made mention of the fact that it is revenue recognition is very important to stakeholders, in the fact that it helps them to make decisions. And with that, you can either lose their trust or gain their trust, because having poor revenue recognition would actually bring reputational damage to both you as a person who is running a business and even to the business at large. And also, she made mention of inaccurate revenue and the things that it can bring. She said it can bring about flawed data. And with this flawed data, you can, start to, blame your suppliers or your employees, because the numbers won't be correct. You might even overestimate the amount you have in your business to run your business. Meanwhile, you are, there is very, very high churn rates, and then everything is just scattered, and it will take you maybe like a while before noticing all of that. And she also made mention of non-conformity with regulatory standards, which can lead to fines for your company. And I know that much more than this. I know when we have more questions to, ask, if we can always ask in the chat, but in the middle line or maybe the crux of all of this is having a standard finance system and recognizing where your money is coming in, money in and money out is very important for your business, as this will help in you overall financial growth and financial health of your business. Thank you so much, Zulfah. So when there are questions in the chats, I would be directing the questions to you as time goes on.
Awesome.
Thank you very much. So we would be moving to the next phase of this webinar, which is revenue recognition methods available for businesses. And this would be taken by our accountant, Mobolaji, Maborukoje. It would be explaining in depth, emphasizing more on what Zulfah mentioned. And let's take note that if we have questions, we can still, ask questions in the chat, and we will be here to answer your questions. Also, this is powered by Tyms. Tyms is an accounting software tailored to, help business owners, CFOs, accountants in streamlining their transactions and to, bring an overall balance to businesses. Mobolaji, can we have you now?
Hi, Omalade. Thank you very much for the opportunity. Good day, everyone. So my name is Mobolaji, and for today, for the purpose of the webinar, we'll be discussing a few revenue recognition methods and how they relate to your various businesses and startups and so on and so forth. So firstly, we'll be having an overview of revenue. So I would like to share my screen, if that is possible. All right, so for today, we'll be going through an overview of basically what revenue recognition is, or revenue in general. So what is revenue, and what are the implications of revenue generation recognition, and also the various conditions we have to look at before we can recognize a particular revenue. And we'll also be concluding with the various revenue recognition methods that might be suitable for our individual businesses. So firstly, what is revenue? Basically, revenue is the money that a company or a business earns from sales of its product or services. So whichever business that you run, you would have like various, like a major operational activity that you run. So your major operational activities might be, if you're a business that probably you sell shoes, for instance. So revenue, money that comes in from the sales of all these shoes or all these clothes or whichever services that you might be rendering or goods that you might be selling, the value that comes in from rendering all of those services is what we term as revenue. So what are the various conditions for recognizing revenue? So for the purpose of this webinar, we'll be looking at them and classifying them under three major conditions. So we have the performance condition, the collectability condition, and also the measurability condition. So these three conditions, for the performance conditions, there are two major conditions that are to be looked at, which are the risk whenever you are recognizing the revenue, or whenever there is a transaction or a sales transaction, for you to be able to recognize the revenue for this particular transaction, the performance conditions that have to be performed include the risk and the reward of ownership of the goods or services in question has been transferred to the buyer by the seller. So whenever you are trying to ascertain, okay, can we recognize this revenue? First things first, the risk and ownership of the goods and services that we are considering in this sense must have been transferred onto the buyer by the seller. So for instance, so under the performance conditions that I was saying, the first performance condition to be fulfilled would have to be like the risk for the goods or services that we might be rendering or selling have been transferred onto the buyer. And also the other performance condition that has to be put into the consideration is also that the seller has lost his control over the goods. So whenever you're making a sales transaction, as the seller, you've sold the shoe out to the customer, you have no other control over the goods or over the services that you are rendered. So in this instance, then you can say you have completed all the performance conditions that is attached to recognizing whichever revenue. Also, the next condition is the collectability condition. So basically, the collectability condition has to do with getting reasonable assurance that payment will be made for the goods or services that you're rendering. So basically, when you're selling a good to a customer, as we all know, we can extend credits or credit facilities and probably sell our goods or render our services on credit to our various customers. So the collectability condition basically is ensuring that payment for the goods or services is reasonably assured. That, in other words, you are assured for payment for this good. So that is like the collectability condition in this regard. So then we have the measurability condition. This condition basically has to do with the money measurement concept. So there are two conditions under the measurability conditions that have to be met, which are the first one, the amount of the revenue can be reasonably measured. So in the instance where we are about to recognize the revenue, the value of the revenue we are trying to recognize must be measurable in monetary terms, basically. So whenever we are trying to recognize a revenue and we see that the revenue we are trying to recognize doesn't match also with this measurability concepts, then it is not a revenue in this instance. So I'll give you instances also of transactions that people tend to think, oh, this can fall or serve as a part or form a part of my revenue, whereas they don't meet several of these conditions. So in that situation, these various transactions are not to be recorded as your revenue. For instance, introduction of capital into your business. Fine, money is coming into your business, but in this instance, they don't mean like the performance. It's not like you've sold goods or render services to anybody to get the money that is coming in from these transactions. So basically, proper classification and proper understanding of the various forms of revenues that we are trying to recognize is very helpful in understanding revenue recognition. So next, we'll move to the various revenue recognition methods that we'll be looking at for the course of this webinar. So for the course of this webinar, we'll be looking at three various revenue recognition methods. So the first one we'll be looking at will be recognition upon delivery. So basically, this revenue recognition method is when you recognize revenue at the point of delivering goods or transfer of goods and services to your customer. So in other words, revenue is recognized when all the previous conditions that have been met, and in this instance, you've delivered the goods to the customer, they've paid you or they've assured you that they are going to pay, and also the value, there is a reasonable value or there's a monetary value or a measurable value that you'll be getting from this particular transaction. So you can then proceed to recognize your revenue at this point. Also, we have the percentage of completion recognition method. So this method basically deals with it is used for long-term projects or contracts, and in this form of, or in this method of recognizing revenue is usually recognized as a percentage of completion. Is usually recognized on the basis of percentage of completion. So basically what this means is for companies or for organizations that undertake long-term projects on behalf of their clients. So for instance, we have a building project that's to last for that are to build for our clients, and the building project is going to cost ₦1,000,000. And for instance, our client has paid us the ₦1,000,000 in full, but we are yet to fulfill the performance condition of revenue recognition. So in this instance, what that means is that we've gotten ₦1,000,000 in full, but we've not been able to deliver the particular services, or we've not been able to deliver the project here, because it's a long-term project, and it takes time to accomplish, or it takes time to materialize. So in this instance, we get ₦1,000,000, but we've not actually worked, or we've not actually earned the value of the money that we are getting. So in this instance, we use a percentage of completion method to recognize this revenue, and we can say this percentage of the revenue of the ₦1,000,000 we are getting from this project is what we are going to recognize. So if the project is 20% done, and we know that the total amount or the total cost for running this project is ₦1,000,000, so we can recognize 200,000. That is 20% of the total amount that was paid as our revenue, while the remaining balance of the money that we've gotten but we haven't earned would be some form of deferred income to our organization. Then third is the subscription basis revenue recognition method. So the subscription basis revenue recognition method is basically for businesses that for SaaS businesses that provide subscription-based services. So in this instance, revenue can be recognized monthly, quarterly, or an annual basis, depending on the terms of subscription for the customers. So in this instance, we are looking at the instance of when there is a SaaS company that gains revenue or that earns revenue from subscription of its customers. So for instance, there might be an annual subscriber for your business, or a quarterly subscriber for your business, and their subscription is to run for 3 months or run for 6 months. And in this instance, they've prepaid already, probably subscription for a full year. And for the SaaS company, or for the business that is receiving the subscription, the total amount of subscription they are receiving at a particular point is still constitutes some part of some unearned income that they've received. And by so doing, this revenue recognition method basically prescribes that revenue would only be the revenue for the month, or the percentage or the portion of the revenue that is due for that month is the only one that will be recognized, whereas the remaining value of the revenue would be some form of unearned income for the business. And over time, as time goes on and this subscription is being utilized, they can then proceed to recognize the revenue as a fully earned revenue. So I believe with this, we've been able to look through the various revenue recognition methods and walk through them.
Okay, sorry for the bit of lag. So thank you very much, Mobolaji. So for those joining us today, we are talking about a step towards profitability, which is mastering revenue recognition. And we had our first speaker who spoke about the importance of revenue recognition. And for the session that we just ended by Mobolaji, we talked about revenue recognition methods available for businesses. And he made mention that revenue is the money that a company makes from either sales and services that they provide to their customers. And he also made mention of conditions that are available for recognizing revenue. He made mention of performance, collectability, and measurability. And he went ahead to tell us about the revenue conditions, recognition methods available. He made mention of recognizing at the point of delivery. That is when you're exchanging with customers, especially when the value is substantial. He also made mention of the percentage recognition, where maybe in case it is a large project and you get maybe like 20% of the total amount, you can recognize that as revenue, and the rest of the 20%, which is the 80%, can be recognized as deferred income. And he also made mention of subscription. Maybe you have a SaaS product, or maybe you have a business that runs on subscription models, maybe either annually or monthly, depending on your terms of sales, actually. So those can be ways of recognizing your revenue. So we have a question on the chat, and I'll be directing that to Zulfah, our first speaker. Somebody said, how does revenue recognition affect or impact tax filing? Zulfah, can we have you for that? How does revenue recognition affect or impact tax filing? Hi, Zulfah, are you there? Okay, Mobolaji, can you answer the question? Can anyone on the call hear me?
Yes.
I think Zulfah and Mobolaji are currently not available. I think it's network. Is anybody on the Tyms team who can answer the question? Is there anybody on the Tyms team who can answer the question? Okay, so I think we'll come back to that. So for the next session, we'll be having Praise Arannilewa, who will be taking us on revenue recognition on Tyms, and you'll be showing us revenue plus prepayments. Praise, can we have you for a few minutes? Thank you.
All right. Good evening, Mobolaji. Thank you for the privilege. All right. So in a minute, I'll be sharing my screen. If I come to the home page and then I come to accounts, I have the chart of accounts section. And then like we had last week, we're able to create chart of accounts. We're able to create our chart of accounts manually and create it by the use of AI, right? Also, if you want to create chart of accounts for the revenue section, all you need to do is to come to revenue, click on revenue, and then add the chart of account under the revenue section by clicking on plus. All right, so I'll just add an account name called subscription. And then I click on save. Okay, so I have my subscription revenue under the revenue chart of account. All right, so if I come to records, there are various ways I can record within that particular revenue chart of accounts. All right, so I can record with AI and I can record a sale manually. So let me just click on record with AI so I can show you what our AI can do. I'll just click on help me record a sale of TV at 5,000 Naira to Emmanuel Ochem, right? And I can say he paid 4,000 Naira. I click on generate record. And here I am, I'm taken to the invoice details page, meaning a record has been created for me and an invoice generated by default, all right? So because a form of payment was made and it was not complete, that's why I'm brought to the invoice details page. So if I click on go back to invoices, I can see the record which has been created for me, the narration, TV sales, customer, Emmanuel Ochem, like I entered, the invoice date, the amount, which I entered as 5,000, and the payment made, which was 4,000 Naira, all right? So if I also click on all sales, there are various ways of importing your revenue or sales records into the Tyms application. You can import with our existing Excel sheets as a template or a format. You can also record sale, the quick create way, which is a fast way, the item-based way, and importing from the Excel sheet, like I said. So if you click on item-based, I just want to show an example of a sale, like a prepayment, so that you can understand how prepaid sales work on the Tyms application, all right? So if I click on this sales account and I select subscription, all right, and I select a particular customer, say Emmanuel, and then I add an item from a list of items I've had within the Tyms application. So I can say Tyms Classic Annual Subscription, all right, submit, and I have it here as 50,000 Naira, 50,000 Naira, all right, and then I can choose to add sales tax if there's a form of tax for this particular revenue, if there's a discount, any form of shipping fee, but there's no shipping fee in this case, all right? So to make effect that this is a prepaid income, I check this box saying this is a prepaid income, all right? And then I enter the amount I received from the customer. If the customer made full payment, I can enter 50,000 as the full payment. And here, this is where it takes effect, all right? So I enter the number of months for which this income should be spread across. Since I said it's annual, it means it's spread across 12 months, right? So I enter 12, and I can see I receive it through cash or any of the bank I have on Tyms. So I click on cash, and then I can enter other information or attachments, and I can just click on submit, all right? So just take note of the details. 50,000 is the cost of this particular item or service which we are selling, and then the income is spread over 12 months. Now click on submit and click on yes, please. All right, so the sale has been recorded successfully under the subscription category, and then we've checked that this is a prepaid income. So how do we check the effects? Now let's go to the accounting section, click on accounting, click on your income statement. All right, so if you click on revenue, you have, this is the sale I recorded through the AI chatbot, right? 5,000, and this is the subscription. The subscription now is captured as 4,166 for this particular month because the 50,000 is spread across the 12 months. All right. So if I go to February, the same thing. If I go to March, the same thing until the subscription period is over. So that shows that I've actually earned the income or the revenue as time goes by. All right. So this is just a brief demonstration of the way revenue, sales, and prepayment work on the Tyms application. All right, so let me just know if I have any other questions and I'll be welcome to answer. Thank you.
Thank you very much, Chris, for that presentation. So I will be back to the question. Zulfah, are you there?
Yes, I'm here.
Okay, so someone asked a question. Someone said, how does revenue recognition affect or impact tax filing?
Okay. Well, the timing of the recognition impacts tax filing. The method of revenue recognition also impacts tax filing. For example, for businesses that record their revenue at the appropriate time, it ensures that it reflects in that current tax year, right? And then depending on, like Mobolaji told us the different types of revenue recognition methods, if we are to use the, for example, say percentage of completion method, the percentage of completion method as compared to the completed contract method, if I may put it like that, there are differences there. Percentage of completed method, it may result in us recognizing revenue and tax obligations more evenly over the lifetime of that particular contract, because it's at every stage of completion that revenue is recognized. However, if we are to now talk of the completed contract method, it may result in, will I say, larger fluctuations in the tax liabilities, right? Because you are recognizing revenue upon the completed contract. So depending on your timing of revenue, your revenue recognition method, these all have impacts on the tax liability.
In a way, that answers your question. But I think someone also asked about the demo, and I would like to say that at times we are available 24/7 for your to support whatever questions or whatever need that you have in the use of Tyms as a software, and also to answer your basic accounting questions. And you can book a live demo with us, and I think somebody will drop the link in the chat. You can ask your questions. We can talk to you as a business owner. We can talk to you as a CFO, as a CEO, to put you through on these accounting processes. And I hope that we would be able to help you in streamlining your transactions, because I mean, we are an innovative platform, and we are trying to put everything together just to make life easy and accounting processes easy for the common man. So thank you so much for joining today, Zulfah. Thank you for joining Mobolaji. Thank you for joining Chris. For those who are just joining, or maybe those who joined, we had we dived into mastering revenue recognition, and Zulfah made us understand that if you are running a business and then you cannot recognize your revenue correctly, it is more like you are running a charity. And Mobolaji put us through the different methods of recognizing revenue, which could be either subscription based on percentage and all of that. And then we had a very short demo on Tyms software on revenue and prepayments using the AI by Praise. So this is to say thank you to everyone for joining up until now. Don't forget that this is powered by Tyms. Tyms is the software which is innovative to, help accountants, CFOs, CEOs, streamlining their transactions and making life easy and life better. So if you want to, read more or know more about us, you can check us out at www.tyms.io. You can also book a live demo with us and we will be available to help. See you again next week, same time, and have a lovely evening. Again, thank you very much, Zulfah. Thank you very much, Mobolaji, and thank you very much, Praise. Do have a good night, everyone.